Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we're diving into 5 major stories. We'll start with the Trump family's massive crypto ventures, including a reported $500 million haul and a bid to dominate Bitcoin mining. From there, we'll look at the AI world, where Anthropic has hit a staggering $183 billion valuation and is making a strategic play with the US government. Then we'll shift to the quantum realm, where a Finnish startup that just raised $320 million is trying to challenge Google while fending off acquisition threats. After that, we'll explore how real estate firm BGO used a proprietary AI to defy experts and predict a Las Vegas boom. And finally, we'll unpack a landmark decision not to break up Google, a ruling that added $160 billion to its value and could push it even closer to Apple. Let's start with a single venture that might just change your perspective on this. The Trump family has already made an estimated $500 million from just one of their new crypto platforms, World Liberty Financial. According to the company's own terms, a Trump-tied entity is entitled to 75% of the money raised from sales of its token, $WLFI. That token was recently valued at $6.7 billion. US, President Donald Trump's sons, Eric, Donald Jr., and Barron, are all listed as co-founders. The token they're selling, sometimes referred to as USD, one is a stable coin. The idea is that for every token, there's one real US dollar held in reserve to keep the value stable. The company says its reserves are managed by a reputable custodian, but beneath the surface of these promises, a crucial piece is missing. Detailed public audits verifying that every token is actually backed by a real dollar have not been released. This lack of transparency is a major concern for financial experts, especially when a project is so closely tied to political power. But that's just one piece of the puzzle. Trump Media, the owner of Truth Social, recently raised $2.5 billion with the express purpose of buying Bitcoin. The company's CEO called Bitcoin the apex instrument of financial freedom. A trust in Donald Jr.'s name holds a stake in that company worth $2 billion. The ambition doesn't stop there. A new venture called American Bitcoin, backed by Eric and Donald Jr., has vowed to become the world's largest, most efficient, pure play Bitcoin miner. The two sons, along with a partner, are set to own a combined 98% of the new entity. The real alarm bell here is what this means for the security of Bitcoin itself. Bitcoin mining is a global competition, and the network's security relies on computing power being spread out. If one single entity controls more than 50% of it, they could theoretically take over the network in what's known as a 51% attack. It's the nightmare scenario for Bitcoin. So when a single politically connected company vows to become the world's largest, it raises serious red flags about centralization. The family has also launched meme coins like $TRUMP. So the thing is, these meme coins are blurring the line between a speculative investment and a political donation. The Federal Election Commission has rules for crypto donations, but the anonymous nature of many transactions makes them incredibly hard to enforce, opening up a whole new world of questions about campaign finance. All of this is happening as President Trump pledges to make America the crypto capital of the planet. While critics have flagged potential conflicts of interest, the White House denies wrongdoing. And this is where the personal business interests and public policy seem to intersect. The administration has not only established a strategic Bitcoin reserve, but has also appointed a new SEC chair known for his pro-deregulation stance. These are actions that could directly benefit the family's known business ventures, testing the very guardrails meant to separate public service from private profit. Speaking of staggering financial figures, the AI gold rush is hitting an entirely new stratosphere. An AI company named Anthropic is now valued at a staggering $183 billion. That valuation is more than double what it was just a few months ago. To put that in perspective, such a high valuation compared to their current revenue shows investors are making a massive bet on the future, assuming Anthropic will not only capture a huge market share, but also maintain incredibly high profit margins. Actually, this is starting to look a lot like previous tech bubbles, especially when you consider an MIT report showing 95% of corporate AI pilots fail to become profitable. So how did the value explode so fast? Anthropic just closed a $13 billion funding round. The company's revenue is also on a tear, surging from a run rate of about $1 billion at the start of the year to over $5 billion by August. Interestingly enough, part of Anthropic's appeal is its focus on safety. They've developed something called constitutional AI, where the AI teaches itself to be harmless by following a set of principles. For big, risk-averse companies and governments, this isn't just a gimmick. It's a tangible feature that addresses their biggest fears about AI, giving them a secret weapon to win over the biggest clients. However, if you zoom out, you'll see another layer of strategy at play here. Who is backing this company? Tech giants Google and Amazon are major investors, turning Anthropic into a key player in their own battle for AI dominance. When we place Amazon's $4 billion investment alongside the deal's requirements, the strategy becomes clear. The deal stipulates that Anthropic will use Amazon Web Services as its primary cloud provider and use Amazon's own custom chips to train its future models. You see, Amazon isn't just investing in Anthropic, it's making Anthropic a strategic part of its own cloud empire, locking them into their ecosystem. In fact, reports say Amazon is considering another multi-billion-dollar investment. This isn't just a startup anymore, it's a high-stakes proxy war. But the most jaw-dropping move might be this. Anthropic recently offered to provide its powerful AI model, Claude, to the US government for just $1. It's a classic foot-in-the-door strategy. The goal isn't to make money on that dollar, but to get their AI embedded deep inside government agencies, prove its worth, and achieve top security clearances. This positions them to win massive and lucrative federal contracts down the line. To prove how serious they are, they've even formed a National Security Advisory Council filled with former US officials. It leaves you wondering, in an AI arms race, this intense, what is the real end game? We were just talking about the sheer dominance of American AI companies, but believe it or not, a European startup is now aiming to challenge US giants in an even more nascent field. Quantum computing, the company is IQM, a quantum firm out of Finland, and they just secured a massive $320 million funding round, catapulting them to unicorn status with a valuation over $1 billion. What's particularly telling is who led that round. 1011 Ventures, a firm specializing in cybersecurity. This signals that the threat quantum computers pose to our current digital world is becoming very real. After all, a powerful enough quantum computer could theoretically break the encryption that protects everything from our bank accounts to national security secrets. This investment shows the cybersecurity world is betting on quantum as a critical part of a new security infrastructure. But here's where the real drama starts. This isn't just about one company's success. It's about a geopolitical power struggle. The EU receives only 5% of global private funding for deep tech, while the US gets 50%. This is becoming a matter of what experts call quantum sovereignty. The European Commission has identified quantum tech as critical for its economic security, with 21 member states signing a declaration to make Europe the quantum valley of the world. Despite this, IQM's co-CEO Jan Geurts recently said, if you compare us directly to the companies which are NASDAQ listed, actually we are not behind. We can actually compete on this level. If that was just the appetizer, the main course is just being served. The real threat isn't just competition, it's being swallowed whole. Geurts warns of a risk where US companies simply use their sky-high stock prices to acquire European rivals. This isn't just a theory. US firm IonQ recently announced a deal to buy a UK quantum startup. This is all happening inside a market on fire, with shares of some public quantum firms spiking over 1,400% in the last year. But this gold rush has experts worried about a bubble. When we place a leading US firm like IonQ with its $10 billion valuation alongside its projected 2025 revenue of only $75 to $95 million, the contradiction becomes clear. The market is running on pure hype. So the question remains, can this European challenger survive and scale, or will it become another target for its giant American rivals? The company's goal is to build a sustainable business, and as its co-CEO declared, we will do whatever is necessary to make that happen. That's a story about building technology for the future, but our next story is about using technology to predict the future. A real estate giant just made a bet that top research firms called mediocre, and it paid off spectacularly. They underwrote a project in Las Vegas expecting rents of $5.88 per square foot. They ended up getting $9. The co-CEO of the firm, BGO, went on the record saying, that does not happen in commercial real estate. That is not luck. So what's the secret? BGO, an investment manager with $89 billion in assets, grew frustrated that everyone was looking at the same data. Their answer was to build a proprietary model powered by by feeding it 20 years of their own past deals to see what actually drove success. The secret sauce here is what's known in the industry as a proprietary data moat. You know, the AI model itself isn't the only advantage. It's the unique, exclusive data it's trained on. Research shows this gives incumbent firms a massive competitive edge because new players simply don't have access to that kind of private historical information. The machine's conclusion was radical: ignore national economic trends and focus almost entirely on hyperlocal market fundamentals. And these models can now use alternative data, like anonymized mobile phone data, to see real-time foot traffic or track commuter patterns. It's a level of detail traditional analysis could never capture, which brings us back to Las Vegas. While the best research out there predicted a lackluster return, BGO's co-CEO said their model was, quote, screaming, it is going to explode. I saw a hidden opportunity, a ripple effect that human analysts missed. It realized companies could save 60% on total costs by moving logistics from California to Las Vegas. The tenants flocking there aren't serving Vegas. They're serving an entire region. This isn't a one-time fluke. This is where the situation takes a more complex turn. The next step is to have I suggest the optimal portfolio mix for the entire company. On a bigger scale, this raises some serious questions. If every major firm develops a similar AI and they all start identifying the same undervalued markets, you could see a massive convergence of capital, creating hyper-localized asset bubbles. It's a fundamental power shift. Now, get this. The company's co-CEO now physically sits right next to his 6-person data science team. That physical arrangement is a huge deal. It represents a solution to the cultural tension between AI recommendations and human intuition, creating a human-in-the-loop system where AI augments professionals, not replaces them. The age of AI-driven real estate isn't coming. It's already here, and it's shattering expectations. It's fascinating to see how a proprietary AI can create a competitive edge. Now, let's shift to how the mere idea of future AI competition is reshaping the legal landscape for today's biggest tech companies. A company just added more than $160 billion to its market value because a judge ruled that Google will not be broken up. For years, the US government has been trying to dismantle the tech giant. The biggest fear for Alphabet, Google's parent company, was being forced to sell off core assets like Chrome or Android. But in a stunning decision, a judge ruled against that breakup, clearing a massive regulatory threat. What really brought this to a head was the judge's reasoning. In his ruling, Judge Amit Mehta pointed to the rise of generative AI, stating that new technologies are breaking barriers seemingly at light speed. Essentially, this sets a wild new precedent. It suggests a company can defend an existing monopoly by pointing to potential future competition from emerging tech like AI. The situation presents a fascinating duality. Instead of driving them apart, this ruling could actually push Google even closer to its biggest rival, Apple. The court is allowing Google to continue its multi-billion-dollar payments to Apple to remain the default search engine on every iPhone. One analyst notes this deal is worth over $20 billion to Apple's services division. By blessing this deal, the court is effectively greenlighting a powerful duopoly, creating a walled garden that's almost impossible for anyone else to breach. Smaller search engines like DuckDuckGo have argued these default setting deals are the single biggest barrier to competition. And this isn't just about search. This decision clears the path for the two giants to deepen their partnership, potentially integrating Google's Gemini AI directly into future iPhones to power a revamped Siri. So while regulators wanted distance, this outcome might lock them together for years. This wasn't a total victory for Google. However, the judge did order the company to share certain search and interaction data with competitors to help them build their own AI chatbots. On the surface, sharing data sounds like a big win for competition. But here's the catch. That data is the absolute lifeblood of an AI model. The fear among experts is something called weaponized compliance, where Google could follow the letter of the law but provide data that's delayed, incomplete, or stripped of context, making it far less useful for rivals. So while Google wasn't broken up, the outcome leaves a lingering question. Did the company just escape its biggest threat, or did the court just light the fuse on a whole new war for AI dominance?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.